5th of April 2017 is getting closer and time is running out for some tax planning opportunities. You've only got just over a month, so don't forget to give us a call if there's anything you want to discuss. Today we're at number 7 on our year-end tax planning countdown. And today I want to spend a little time talking about capital gains tax and capital losses, because don't forget about those. Even though the asset may be worthless, it could be worth some cash to you. There have been changes in the rates of capital gains tax. In 2015-16, you paid 18% if you were in the basic rate band. Otherwise, you paid 28%. No change in rates for residential landlords in the following year. But for the rest of you, capital gains in your basic rate band has now dropped to 10%. And if you're in higher rates, it's only 20%. So it's a good time to consider realising assets that are perhaps heavy with gain, because the rates are at a historic low, and you never know when the rates might start to creep up again. The annual exemption is the amount of gain in a tax year below which you pay no tax. It's currently £11,100 each, and that's for each of you in a couple, but also to your minor children. Couples enjoy some additional benefits. They can transfer assets between them and pay no tax. But this comes with a warning. There are some reliefs for capital gains tax where there is a holding qualification, such as entrepreneur's relief, and transferring to a spouse, you could lose this relief. Anyway, you can use the tax-free transfer to make sure you make best use of your 2 annual exemptions and your 2 basic rate bands. I want to briefly turn my attention now to the question of losses. If you dispose of an asset at a capital loss, that loss will automatically be set off against any capital gains in the same year. The resulting net gain will then be reduced by your annual exemption or any reliefs, such as entrepreneur's relief. So use your capital losses wisely. Unless the market conditions dictate that you have to realise the loss at a particular time, realise the loss when it is most useful to you, either to reduce your tax to 0 or hold the loss creating asset back and realise it in a year when you know you will pay the higher rate of capital gains tax. One thing to remember about losses, and that is that they have to be claimed on your tax return. If you don't put them on your tax return, you lose them forever. You have to establish the loss on your return, and then it will be carried forward indefinitely and can be used against the next available gain, whenever that should be. So what should you do before the 5th of April? Well, it's a little bit late in the tax year, but if you're about to dispose of any assets, consider transferring them into joint names to make the best use of your annual exemptions and basic rate band. Also, consider the timing of any sales that will crystallise a capital loss. And finally, if you are staring at a capital gains tax bill for 2016-17, and you have other assets which have become of negligible value, then a negligible value claim will have the same impact as selling those assets at a loss, and the loss will be set off against the capital gain. As always, this is a quick run through of the legislation and the rules surrounding capital gains tax. Come and speak to us if you need to, and quickly. I'm Alan Long from Long Partnership, making life less taxing.